Today we're going to continue with Chapter 2. We're now going to look at the third module, which covers Learning Objective 3. And here we're going to employ the actual bookkeeping procedures that are used to record transactions. That is, we're going to first record transactions in the journal and then post these journal entries to the ledger. The ledger is going to be in our visualization of the informal T account. So the ledger will be made up of T accounts. Now, we know that it's clear that it's really not possible for any large corporation to record transactions to use or only by using the accounting equation. Even a small business has hundreds of events that take place each week. That would mean that each line would have to be added time after time on the accounting equation. Clearly not practical. Even in a large corporation, if a computer system can handle it, it's not efficient to do so. So we have to consider how transactions are actually recorded. So we first will use what is known as a general journal to record transactions. And we use the term general because there are some special journals that we do not include in the course, but we are just looking at the general journal. There are cash receipts journals, there are special cash disbursements journals, there are special journals for handling accounts receivable, and so on. So we have various journals that will not be considered here, and we're just going to stay with the general journal. Now, the general journal, what makes it is useful is that it is a chronological record, a detailed accounting record in chronological order of the transactions, and that is in a standardized format. And because we record all transactions in the journal first, it is known as the Book of Original Entry, the Book of Original Entry. Now, why do we abandon recording directly in T accounts? Clearly we know why we don't record in the accounting equation. It's clearly not practical. Why did we abandon going to the T accounts directly? Well, first of all, there are several benefits. There are 4 benefits of using the journal. Number 1, it is clear that it's much easier to follow if you have a transaction in one place. So there is a complete record of the transaction by recording it in the journal first. And the complete record will also include an explanation. Now, typically, for standard transactions, explanations are not used. And what do we mean by a standard transaction? Well, if Smart Touch buys office supplies, they debit office supplies, credit cash. When you see that, you know what happened. They use cash to buy office supplies. However, explanations can be very useful if the transaction is unusual and not part of the company's normal operations. Second benefit is that we see the transactions in chronological order, easier to trace them. We'll be able to find them in case we have to look something up a couple of months later. We know exactly where to find that event. It also prevents or helps us locate errors because the debits and credits for each entry could be easily compared. You have to think about when you record, if you have the transaction on one page or in one place, it's easy to see that the debits and the credits can be equal or should be equal. If you make a mistake, you go back, you've got the transaction in chronological order, and you could see whether the accounts were incorrect or whether or not the amounts were not correct, or maybe the debits didn't equal credits in that entry. This is a benefit over the T accounts because the T accounts are fragmented. And what that means is, and we're going to see this in just a minute, let's say we take Smart Touch and the investment of $30,000 to start the business was recorded as an increase in the asset cash by a debit and a credit to the common stock account. Well, that might look like, well, gee, I see the debits and credits there. I see they're equal. I understand that's an investment. I see the accounts are correct. I don't see the benefit of the journal over the T account. Well, here's the issue. If you remember from the chart of accounts, cash might be account number 101. Common stock could be account 301. These could be on two totally different pages. This could be on page 1. This could be on page 6. So it would mean that you'd have to leaf through or scroll on a computer to search for the account. So the information is fragmented. The transaction becomes fragmented, and therefore it's not impossible, but it is more difficult to prevent and locate errors. Now, the process that we're going to be looking at in a second, when we first record transactions in the journal, we call this process journalizing. And we could have more than one account involved on the debit side, more than one account involved on the credit side. So when there's more than 2 accounts or 3 or more accounts, we have what are known as compound entries. After we make the entry, the process of going from the journal to the ledger is known as posting. So let me see if I can just get onto the whiteboard for you. And here is the way the process is going to look. The journal to the ledger. We first record it here, journalizing. When we move the transaction to the ledger, these are the T accounts, that's called posting. That's the second step. Since we record it in the journal first, we said that this is sometimes called the book of original entry, the journal. The ledger is sometimes called, since we do this second, the book of final entry, the book of final entry. And again, the process is called journalizing when we enter a transaction in the journal, and it is called posting when we move that transaction to the ledger. Okay. Now, Exhibit 2.6 shows the flow of accounting information. And again, very simply, if the owner of Smart Touch deposits $30,000 in the bank account, you get a source document. The document goes to the accounting department. They know you're going to debit cash for 30, credit equity for 30. After they analyze it, and what do we mean by analyzing transactions? Well, this is the way you should be thinking. If you see a deposit after investing in common stock for $30,000, you know you have to increase the asset cash and you have to increase the equity account, common stock. We know that assets increase by debits, and we know that equity increases by a credit. So again, the transaction will be entered into the records by debiting cash, and they're not showing you, but of course they would also increase capital stock by the same amount. Now, the journal entry that we're going to make. Now let's get involved with how do we make these journal entries? What's the journal entry format? Journal entry format is standardized, and this is something, again, from the perspective of doing assignments, taking exams, you have to follow this format. We're going to look at a ledger account in a second. First column is the date. Next to that are the descriptions of the accounts that are going to be debited and credited. Debit comes first, and it is against the margin. And there could be more than one. As we said, you could have a compound entry, so there could be various accounts that are debited. And the same thing's true here. There could be accounts that are credited, and they go second, they're indented, and then finally the explanation. So let's take a look at that format. And once again, as we said, you've got the date, you have the account titles where the debit is against the margin. On the left side, credits are indented, and the dollar amounts are entered here. And there could also be an explanation. Now, we're excluding the reference column for now. The reference column would usually go about here, and that would include the account numbers. These are the general ledger account numbers. General ledger account numbers. And this is going to be the general journal. Now, let's take a look at some transactions. We'll just do a few from the series of transactions that we've already covered for SmartTouch. So in transaction 1, we know that SmartTouch sold $30,000 of common stock on November 1st. We know that cash is received and common stock is issued. This means that cash received is an asset that increases, so we debit cash. And we also know that equity has increased, and we increase equity by a credit, making the actual journal entry. Notice the format again. Now remember that this is, if we wanted to be very clear about this, this is the general journal. Might be some kind of a page number here. The date comes in the first column. Credits placed first in and against the left margin with that amount. And there could be more than one debit. Credits are indented. And of course, the explanation could be added. All debits are listed first at the left margin. All credits are listed second and indented. And the explanation is also at the left margin. Next, this transaction has to be posted. So we have to post this to the general ledger. The general ledger will consist, as we said, of the T accounts. So again, this is the journal. We're now going to post into the ledger. When posting to the ledger, we're going to post the debit to cash to the cash T account, and we're going to post the credit to the common stock account. And the posting process is presented below. So again, if we had to set this up and label it properly, this is the general journal. And again, there could be a page number here. Say it's page 1. The process of, now again, recording the journal entry is journalizing. After we journalized, now we post it. Posting it means we take the dollar amount of the debits and move it to the appropriate accounts. Since we debited cash, we moved $30,000 to the cash account on the debit side. Since we increased common stock in stockholders' equity, we move this to the credit side of the common stock account. Now again, the benefits, as I said, these could be on totally different pages. The cash account account number 101, common stock account, account number 301. They could be, cash could be on page 1 of the general ledger. That's, again, should be labeled. So this is the general ledger. Cash could be on page 1. Common stock could be on page number 6. So again, it is fragmented when we go to the ledger. Now again, it's absolutely the same effect as the process used to enter transactions on the accounting equation. Increase the asset cash, increase equity, same amount, $30,000. Let's try another transaction. In transaction 2, Smart Touch Learning purchased land for $20,000 in cash. So when we analyze the transaction, and again, we shouldn't forget that, and I'll try to go back to that whenever possible. Don't forget about the analysis. What happened in this transaction? I used $20,000 in cash to buy land. That $20,000 comes out of the cash account. Cash is an asset. We reduce the asset cash by a credit. Land is now being acquired. We increase an asset, land, by a debit. So we know that we're going to debit land for 20 and we're going to credit cash for 20. So when we make that journal entry, again, the format exactly the same as always. We will have the date first, land, the debits come first against the left margin, and then the credits, and then the explanation. Now, of course, we would have to post this to the general ledger. And that's what we do here. And again, it's the same process we had before, so that, once again, this is the general journal. This is the general ledger. The process here is journalizing. And the process here is posting to the general ledger. Okay, so posting to the GL or the general ledger. Okay. Next, transaction 3. Smart Touch purchased office supplies on account. Now again, we know that this means that they didn't pay for the office supplies. This is, again, as we call it, open or trade credit. And that happened on November 3rd. So we acquired an asset, office supplies. So let's analyze the transaction. Asset goes up by a debit. So you debit office supplies for $500. And we've also incurred a liability, an open trade account payable. And we therefore credit accounts payable for $500. And once again, journal entry in its standard form. So again, the date, all the debits to the left, credits are indented with the explanation purchased on credit. Next, we have to post to the ledger. And once again, same as we've been doing throughout, we're going to have a debit to office supplies and a credit to accounts payable. And once again, this is the posting process going to the ledger. So to summarize, once again, journal to the ledger, T accounts. This is the Book of original entry, the ledger's the book of final entry. Journalizing first, and then we post them. Now, what is going to happen is that the T accounts will form the basis of preparing financial statements. But before we do that, we have to ensure that the debits and credits are equal. And what we'll see in our next module, there's an intermediary step called the trial balance. So we'll pick that up in our next module.